Good afternoon, everyone. Welcome to the Tuesday, January 17th edition of Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And joining me today is special guest Diana Avadar, our Head of Trading, as well as David Burrows, our Chief Investment Strategist and President here at Barometer Capital. So we've got quite a show lined up with our experts at hand. On today's show, we will provide you with a brief macro overview and, as always, make time to address your salient questions at the tail end of the conversation. So with that, I turn the conversation over to our one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thank you. Thrilled to be here.
I'm sitting downtown today. It is slowly filling up. Tuesday, Wednesdays, and Thursdays seem to be awfully busy downtown. Certainly they are in the food court. And so it's nice to see the world normalizing. I'm glad to have Diana on today. I thought I'd ask Diana to join us today for a little bit of trading color. The year started well. We've seen improvement in our indicators. And we, of course, are always trying to read between the lines and make sure that sort of the way that we're positioned lines up with what's happening in the market. And that has to do with economic data. It also has to do with investor positioning and sentiment and so on. And so I'm going to come back to Diana shortly, but I just want to go off the top sort of from a very high level, as we always do. Just take a look at the sort of big, broad asset classes as they lie. Here's the S&P going back to the 1980s. We know that during the 1980s and 90s, the bull market was supported by a generally rising 200-week moving average. And there were lots of significant corrections along the way, but they were bull market corrections until ultimately the tech wreck came in 2000. And we spent 13 years meandering back and forth across that 200-week moving average in a series of cyclical rallies and declines. But the market made no progress in 13 years. During that period of time, cash flow in the S&P 500 quadrupled. So in other words, it grew into its share price. And ultimately, we blasted off again. We took out the highs in 2013, and we really have remained above that 200-week moving average ever since, despite the fact there have been some relatively, unsettling periods, 2015-16, which was the Asian slowdown. We had the sell-off in the fourth quarter of 2018, which was particularly problematic. We had the COVID sell-off, which was the fastest, sharpest bear market in history, very quickly reversed itself. And we've had this bear market that we went through from the beginning of 2022, really through October. Now, I know it has been a maybe out of consensus view. Our view was that the October low tested the lows we saw in June, and that likely was the ultimate low. We've seen the market now work higher over the last 4 months, continue to work its way above the 200-week moving average. So in our view, we continue to be in a structural bull market for equities, which the US started leading in 2013. Other markets joined along the way. When we look at what's working, though, we have seen regime change from the time where really 2003 until 2021, we had the NASDAQ or growth stocks leading industrials. And we've seen a nice reversal over the last sort of 12 months as tech kind of gave up gains. The Dow got a footing and started to outperform. And strangely enough, industrial stocks are clearly outperforming growth stocks at this point. And that is a significant regime change. This type of shift when it takes place tends to happen and continue for quite some time, as it did after the period in 2000. And it's one that we want to respect. When we look at fixed income markets, we think we saw a generational low for interest rates in 2020, much like we did at the end of the 1940s after the Second World War, and that we are more likely into a rising rate environment in fits and starts than to continue this falling rates that we saw since 1981. And that's really important because, as we continue to say, what works during rising rates tends to be quite different than the types of assets that benefit during falling rates. So it's at your peril, I think, not to recognize that regime change, because positioning is such that it has been set up for 40 years of falling rates. It's going to take a long time for people to slowly reposition. But very clearly, we've seen a regime change. We broke the downtrend in rates going back about halfway through 2022, after seeing rates rise from 0.4% ultimately to almost 4.5% on a 10-year Treasury note. We've consolidated since then. You can see we got a little overbought. And so the market has been consolidating over the last 4 months. We're sitting at 3.5%. Perhaps the view that the Fed is getting closer to sort of a high terminal rate for this cycle. On commodities, again, we saw regime change going back into the late part of 2020. After a bear market that started in 2008, we reversed, and monthly we worked our way higher into April of this past year. Actually, 4 full months past the point where the S&P started to correct, the commodities started to pull back a little bit. We've consolidated. We basically traded sideways to up a little over the last 5 months. Again, that is outperforming the S&P, which was trading down over the 5-month period. But again, we were working off kind of an overbought situation. When we compare a broad-based measure of commodity prices versus the S&P 500, again, regime change, commodities underperforming from 2008 through 2021, outperforming and ultimately breaking the downtrend in 2022. And again, we spent 4 months consolidating that win. You can see it more clearly if we compare it versus the QQQ or tech stocks. And this really is kind of long duration versus short duration. Short duration meaning the DBC made up of commodity prices that get set every day based on supply and demand. If this supply is short, prices go up tomorrow. Versus the QQQ, where a lot of the companies in the NASDAQ sell sort of subscription-based models. Price increases are not so readily to come when there's inflation. And so people have been moving money into sort of reflationary assets. And again, that's a regime change. It's a significant change to the positioning that people have had over the last number of years. If we compare the commodities index versus bonds, an even bigger shift. So we know that commodities are now outperforming equities in general. They're outperforming bonds. And so this has become an important asset class, even though if you looked inside the S&P, it's a relatively small set of companies that produce commodities and relatively less important inside the index. But as investors, we want to own the things that matter right now. There's real estate versus commodities, real estate being a long duration asset. You lease a building up for 10 years and that's a set rent. Maybe there's some inflation protection in it, but most likely not. We saw the real estate ETF RWR versus the DBC put in a big double top, 2016, 2020. That was a big topping period. Now real estate performing worse than commodities, certainly has been that performing worse than equities. Long duration versus short duration, a major regime change. So big picture here, commodities look quite interesting, beginning of a new bull market. Equities continue to be in a bull market, although the types of equities that have been working has shifted. Fixed income after 40 years of a bull market is now in a bear market. And while it may have some cyclical rallies, probably not a lot of total return to be had, in real estate underperforming everything. US dollar, after a very sharp move higher through 2021, looks as though it's rolled over. This is important because in times of a weak dollar, it tends to be risk assets do a little bit better. And this is sort of continuing. The most recent shift was we broke this rising 200-day moving average in the US dollar versus Great British pound, euro, and yen. And we know that in our local market, the Canadian market, certainly Canadian dollar has been firming. But relative strength is clearly waning, not yet at an oversold point. So I've asked Diana to join us today. We're now a short time into the year, 13, 14 days into the year. And we've seen some interesting market behavior. Market's been pretty strong, but we know that there's been tons of concerns around recession and earnings degradation that might be caused by a rising rate cycle. But Diana spends her day on the phone and in chats over digital communications with, I think, 26 or 27 different trading desks. She sees some interesting stuff from a variety of spots. And Diana, I thought I'd just ask you, what has been showing up in the conversations you've been having that people seem to care about?
Right. Dave, thanks for having me on. It's always interesting to see what it is that interests people and what they want to talk about most. And this is the chart that you have up is economic data. Well, that's exactly it. Economic data is at the top of the mind of everybody. Market is a forward-looking pricing mechanism, and 2022 has priced out all that inflation. Back in June, we were at 9.1%. So everybody's watching data like a hawk, and everybody's talking data like a hawk. ISM manufacturing and other and ISM prices have come in, as you can see in the chart, quite substantially. So whatever the Fed is doing, and all of the central banks, the rate hikes that are one of the fastest in memory, are actually working. And though the rhetoric that the Fed is showing us is still hawkish, there is a feeling out there that seeing the economic data come in, they're not going to want to risk an accident. They don't want to run the economy into the ground. They just want prices to come in a little bit. So we see that the ISM prices have come in quite substantially. We also see core CPI, which is very important. Actually, Canadian CPI came in today lower than expected, which is quite nice. Maybe Bank of Canada can hold. Remember, they were the first ones to raise 100 beeps right off the bat before the Fed, so they were fast and aggressive. Maybe they can stop first, and that would be a relief to consumers. So CPI has come in quite substantially in the U.S. from 9.1% in June to 6.5% was the last reading, and the core even lower.
And Diana, interesting. When we're always looking at year-over-year data, when we look at the month-to-month data, we've now had 3 months where actually inflation has been negative.
Yeah.
So it really, the longer this plays out, the more it impacts those year-over-year numbers. And of course, what we care about is what the numbers are going forward, not the numbers that were behind us. So market seems to be taking note of this.
Yeah, and I would just add that 2022, the market priced in a recession, is pricing in the recession. But some of the data that's coming up is maybe pointing that we may or may not have a recession. This is used car prices, and those have come in quite substantially. Remember, new cars had shortage of components. They didn't have enough cars on the lots. Used car prices have rallied up substantially. They've actually just round tripped. So everything is kind of normalized. CPI has come in, and used car sales. Yet the labor market, which is the chart that you're showing now, is still quite strong. So central bankers, the Fed, doesn't want people out of work. What the central bank wants is wages to moderate, to not go up so high. And actually that has happened. So while the labor market is strong, wages have moderated, CPI has moderated, ISM prices have moderated. We might just have a soft landing, or maybe not a recession. That's kind of what's being discussed in the chat rooms that I'm part of. Yeah.
So Diana, we spend all this time reading opinions. Everybody publishes, of course, a year ahead look at what they expect to happen. Everybody from the folks that are in Davos right now, through the various bank strategists, talk about the fact that we're likely to have a recession. Some think it's a hard landing, some think it's a soft landing. Some people don't think that there will be a recession, but certainly there's been lots of fear. And we've been having this debate since the beginning of the rate hike cycle, like over a year ago. And so one of the things I always try to think about is what's been priced in already, and what maybe could still be a surprise. When you have the biggest accidents in the market, it's when you get a big shift in the data and nobody's ready for it.
Right.
So what are you seeing on sort of the positioning and sentiment front?
So positioning and sentiment both are very negative. The chart that you guys have in front of you is the Bank of America allocation to US equities by their private high net worth clients. and January and December have been brutal. They finally caught on. I guess they saw their year-end statements and said, "Oh my God, let me sell some equities at the absolute worst time." I mean, they've already taken the downdraft. So outflows have been quite high, and sentiment has been abysmal. I mean, you hear the headlines from everywhere: inflation and recession, and quite frankly, the forecasters have missed 2022 targets by 25%. Some 40 strategists, if you average them, their target was 25% higher than where the year ended. And even the Fed forecasted 2022 rate at 1.5%. They ended at 4.3. So, these forecasts can be off quite a lot. So sentiment follows the news headline. Flows, these are flows, what you're seeing on the screen, they've been negative. So weight, allocation, flows, and sentiment are all quite negative. And at the exact time that inflation is coming down and employment is still holding quite strong. If employment can stay strong, and I know that you've been seeing headlines of, this company's firing and that this company's cutting headcount, but they hired a lot over the last 2 years, 20 and 21. So they're not laying off nearly as much people as they've hired over the last 2-3 years.
It's really interesting. We've been watching the market lift since October. And against that, there's just been this incredible onslaught of selling by private investors and institutions.
And retail.
Hedge funds de-weighting, not wanting to get caught. I think still interesting enough, 2008, even though it's 14 years ago, is still fresh in everybody's mind. And the big fear is I don't want to get caught in one of those big generational downdrafts, which frankly, have happened once every 40 years. They happened in 1929, it happened in 1973, 74, and it happened in 2008, each about 40 years apart. It takes a long time to get to the point where there's that much excess.
But credit is acting well. Credit is doing really well in the first week of January. Credit Suisse, which is negatively in the headlines, placed $3.5 billion in debt quite successfully, and some $50 billion of debt has been placed successfully in investor hands. That's the most since 21. So credit is doing okay, unlike 2008.
So we've discounted a lot of stuff. Probably the not the least important is earnings. Of course, that's the big fear, is that earnings take a big hit. And again, this has kind of been discounted. We talked about some of this data that we got from Jonathan Golub at Credit Suisse, where he talked about the seasonality of earnings trends. Maybe explain what's on this chart.
Yeah, so earnings expectations, as derived by the analysts that cover the various stocks, have been coming down quite steadily since the beginning. So expectations, because of all the different negative headlines that feed into this, be it growth, margins, cost cutting, headcount loss, recession, you name it. So estimates have come down quite substantially. So the bar has been, and we're now in earnings season, and we've had very little, it just started. So we've yet to see earnings. Earnings is a bar that we need to surpass, because everybody worries about earnings recession. But so far, so good.
Interesting to see, actually, in the last week, estimates have been raised. And, we know seasonally, the fourth quarter is generally a quarter where we get estimate revisions lower because analysts realize maybe they've been too optimistic with their numbers and year end is coming. So certainly we got that trend this year. We got it way more accentuated. And perhaps maybe they've discounted in more than they needed to discount. Lots of fear around earnings. We always start with the bank earnings, and we've had most of the big banks in the US report. We were talking about this on Monday. I thought maybe it might be worth bringing up. Talk a little bit about what the reaction was like.
Yeah, so, Friday was the day that JP Morgan and Bank of America and Citi and Wells Fargo, they've all reported. That's the beginning of the earnings season. And, JP Morgan, for example, which is the biggest bank, had revenues up 13% and EPS up 7%. And JP Morgan is more a reflection on the boots on the ground, the economy, the real economy. You know, so it actually opened up in a hole, down 3.5%. And if you look at the two boxes that are highlighted on that chart, if you can go back, the first one and is where it was in the open, and then the second box will show you how much it rallied over the course of the day. JP Morgan numbers, for example, were not bad at all. And by the way, they didn't let go of anybody yet. And by the way, they were the best bank that survived in 2008 as well. So a lot of this has been priced in, and the way the market absorbed the news was very positive.
We've been talking about this over the last few weeks, that relative performance versus the market bottomed in July for the banks. And against all this talk of a hard landing, the relative performance of the banks has been remarkable. JP Morgan was $101 in October. It's $140 today. Like, that's a huge move against, some boogeyman that is a hard landing. Even along the way, Jamie Dimon was very, very cautious in his comments about the economy, warning that the economy would slow down. Certainly the market seems to have another view on JP Morgan shares.
It's okay for him to manage expectations and to manage expectations to a conservative scenario. I mean, we don't know what's going to happen. Hopefully we have a soft landing or just a little slowing growth as we check back into normalcy through normalization of rates. I mean, some of the stock is up 30%, and you were talking about a regime change. Caterpillar was trading at all-time highs. If you looked at the tech stocks, they're down 50%, you would have felt different. So there certainly is rotation coming into certain sectors.
That's great. Diana, thanks so much for joining us.
My pleasure.
And we're going to have you back regularly, because you always bring some interesting insights, against the more technical quantitative stuff that we're doing. So thanks so much. Folks, our process is our process, and we've tried to follow rules all day long. Our view is a very high percentage of return comes from getting to the right asset classes, which we talk about every week, and the sectors that are showing leadership. About 30% of return comes from finding the right securities. So we have a top-down model that helps us to understand what's actually happening, where the money's getting put to work, try to identify sectors and themes that are benefiting from that. And then we do this bottom-up work where we take 60,000 global securities and drill down to try and find those that meet our fundamental tests and that are behaving well relative to their peers, so we can express our view in these groups that we care about. And then, of course, we run stop losses on all of the positions. The top-down work is driven by breadth, and what we're always looking for are the leaders. And we know that when groups come toward the end of a decline, eventually the strongest securities turn up first, and then the buying spreads to more and more securities within that group. And through the course of a bull market, breadth, or the percentage of securities performing well, expands. There's no bear market ever in history that took place while breadth was expanding. Now, eventually, sooner or later, there's a problem, and the weakest securities sell off first. Generally, they aren't noticed by the market so much because the market leaders are carrying the day. But if enough securities roll over, eventually the group starts to be impacted, and one by one, we go the other way. So we spent a lot of time on this. As we came into this year, in the first week of January, we noted that the percent of stocks trading above their 50-day moving average in the NYSE had started to improve, even though the NASDAQ made a new closing low in the last week of January. Last week, we highlighted the fact that all of our 4 short-term indicators had turned up: percent of stocks above the 50-day, percent of stocks with positive weekly price momentum or upward trajectory, percent of stocks making new highs versus new lows. I think last Wednesday, there was only 9 new lows, which was the lowest number going back to 2001. And the percent of stocks trading above their 30-week or 200-day moving average, or 150-day moving average, again, moving higher. So this was really encouraging. The Canadian data was even better. As we sit this week, the numbers have continued to get better. So remember, no bear markets while breadth is expanding. And that's why we track it regularly. The percent of stocks trading above the 50-day moving average in the US is now over 70%. That's a measure of intermediate term trend. The percent of stocks with positive weekly momentum is over 70%. Percent of stocks in uptrends is now over 50%. So more than 1 in 2 stocks are in clearly defined upward price trends. And the percent of stocks trading above their 150-day or long-term measure of trend is now about 65%. In Canada, they're positive, and globally, they've turned positive. Some markets better than others. But we always want to track the progression, and things keep getting better. This is the S&P. We've been looking at this regularly every week. This is the low in June, where 12% of stocks were in uptrends. When we made the low in October, only 10% of companies in the S&P were in uptrends. But when the NASDAQ went back and made new lows at the end of December, actually the S&P was much better, even though it contained some big NASDAQ stocks with 42% of stocks in uptrends. And as of today, 60% of the 500 components of the S&P are in uptrends, which is why the equally weighted S&P has been doing better than the market cap weighted, which has, of course, Apple and Amazon and Netflix and Google and so on, which have been weighing the index down. When we look at the NYSE, which is all the companies that trade on the NYSE, a much broader number, it's actually better. The bottom in October with 18% of companies in uptrends, the market was at 13,500. We're at 16,000 today. And in fact, we've reversed this bottoming pattern we call a reverse head and shoulders pattern. We've broken above this previous resistance. We're above all the moving averages, 8-day, 21-day, 50-day, 150-day, and 200-day moving average. And we continued and broke out now 52% of companies in uptrends. So things are healing internally. Now, I talked in the Twitter feed about the fact that we had some data that we wanted to touch on that we think is rare and really important as we look going forward. So there's a number of different measures of breadth, meaning how broad is the advance. Over the last 10 days leading up to Friday, advancers beat decliners by over 2-1. When this happens over a 10-day period since 1950, the data is compelling. So these are all the dates where we had 10 days of advanced decline greater than 2-1. This was 1 month returns where we had 2 negatives of all of the occurrences, the worst one down 1.5%. The average return was 3.8%. It was up 85% of the time. When you went out to 3 months, 1 negative year, 1962, with a 0.9% negative return, an 8.5% average return over the 3 months, 92% of the time. And when you got to 6 months, 100% of the occasions were positive with a 16% positive average. And over 12 months, 1 occurrence negative in 1987, down 6%. But 92% of the time, market was up an average of 20.2%, including that negative year. I think that's very compelling data. Now, I think that when breadth is expanding the way that it is always compelling, but these are particularly rare data sets. Here's another. Now, this is a little bit complicated, but this takes 3 different measures of breadth. In the last number of days, we had 2 Whaley breadth thrusts. We had Walter Deemer breadth thrust. It's his measure. He invented this and found the data. And we had 3 70 breadth thrusts, and all of them happened in the same day. Now, since 1957, that's only all happened together 1, 2, 3, 4, 5, 6, 7 times. 42 days out, there was 1 occurrence where the market was down 4.8%. So 86% of the time was up an average of 5.6%, including the negative. 60 days out, 84 days out, 105 days out, 126, you can see it. 100% of the cases, the market was positive, and the numbers are not small. So we spent a lot of time talking about the fact when you get through bull market corrections, we get a long advance in front of us. And this is what the data looks like. These are data points we get at important market lows, not important market tops. Let's talk about leadership briefly. We talked about the sector work coming into the year. We noted the fact that at the beginning of the year, the vast majority of sectors had very small percent of stocks in uptrends as marked by this distribution curve. So in other words, the very best two sectors at that time were banks and savings and loans or regional banks, where between 38 and 46% of stocks were in uptrends. But you can see that most of them are in small letters. That means that breadth had been deteriorating. In other words, fewer and fewer stocks holding on in price. The average sector was at 24%. Sorry, that was on October the 6th when the market made the low. When we got to year end, picture was different. More sectors in capital letters. Strangely enough, oil service and oil, precious metals. These are highly economically sensitive groups. The highest breadth readings were coming from steel, bank, and oil, including also insurance, aerospace, and builders. And when we fast forward to today, as of the 13th, which is Friday last week, you can see how many are now in capital letters, meaning they're showing expanding breadth. The average sector has 44.8% of stocks in uptrends. The most economically sensitive groups on the market are doing the best. It tells us that investors are positioning for the next economic cycle. Right or wrong, of all the moving parts, we are seeing investors come down to say, we think prices are compelling, valuations are compelling, and that this too will pass. So some key groups, we talked last week about how materials, which includes steel, chemicals, metals, and precious metals, we're in this bottoming pattern. And if we were to break above these levels, it would show we've likely had a bottom in. And here we are this week, 4 days later, substantially above those levels. We can always pull back, but we have clearly broken out. When we looked at the oil and gas equipment and services group, we were just starting to get through this level, again, showing a bottoming process in place. We had 22% of oil service companies doing well at the bottom, 48% as of last week. And again, we've followed through. So these aren't failing, they're following through. When we look at home construction, a highly economically sensitive group, a group that clearly is hurt by higher rates, same bottoming process, 44% of stocks in uptrends as of December. This week followed through to the upside. So we continue to see healing and bottoming across a number of different sectors. When we look at our portfolios, the groups that we're focused in continue to lead the market. Financials, we have a 6% overweight. We've added to over the course of the week post earnings. Industrials continues to be close to a double weight. Diana made reference to the fact that Caterpillar is performing as well as it is, and certainly the defense stocks have been performing well. Materials, you can see, has become an even bigger overweight at 15% versus the S&P weight at 2.8%. Energy is a significant overweight. And then when we look at the defensive, consumer staples is a little bit less than market weight. Healthcare is a little bit less than market weight. And we continue to be very light on technology, consumer discretionary, and communication services. Real estate is a 0% weight in the portfolio. We are at a time when being targeted could make a substantial difference to portfolios over the course of the year, as the correlations sector to sector are very low. Some sectors doing well, some sectors doing poorly. Outside of the US, we continue to see strength. Europe stock 50, again, has completed this bottoming process, 50% of stocks in uptrends versus 22% in October. We know that over the course of the week, that continued on, now 57% of stocks in uptrends. Mexico has been now outperforming since early in 2020, and actually we're now making multi-year highs. And we've seen improvement in, sorry about the labeling here, this is Thailand. The Thailand ETF has moved up from the low in October at $62 to $80 today. And again, outperforming US markets. So for the first time in many years, some of the global indices are outperforming the S&P, and that includes the Canadian market, which we've talked about over the course of the last few weeks. New opportunities for diversification and groups that are underowned and underrepresented in client portfolios. So it's been a pretty strong start to the year. The S&P year to date, as of the end of the day yesterday, was up 4%. Russell 1000 up 4.3%. Gold up 5.5%. NASDAQ's had a nice bounce. There's been a bit of short covering in there. We're sort of cautious on that because the chart patterns are not particularly good. Russell 2000 up 7% so far on the year. EFI, which is the global index, up 7.4%, and emerging markets up almost 9%. This, I don't think, is what many people expected coming into the year. From a credit risk perspective, credit premiums that investors are demanding, or yield premiums to buy corporate bonds, are falling. That tells you there is less and less expectation of a hard landing. And the last piece of data I'll leave you with is a variation on the data we looked at year end. At year end, we said what happens in the first week of the year often follows through for the rest of the year. Let's take that a little bit further. When we look at what happened for the first 5 days of the year, when it was over 1.4%, and when the year before was negative, we can see the market was up on average 26.4% and was positive 100% of the occurrences. So lots can still happen over the course of the year. The data can change, but we are positioned for a stronger market. We are positioned in groups that led through most of the end of last year on a relative basis, and they've started this year continuing to relatively outperform. If we're right and we're at the beginning of a new cyclical bull market, it's not going to happen all at once. There are going to be fits and starts. There's going to be pullbacks and consolidations. But likely over the next 18 to 24 months, we can see some sizable returns. Remember, there's that chart. In between these bull market corrections or bear markets, cyclical bear markets, whatever you want to call them, you get these long runs in price. And it's not every stock and it's not every sector. If we can be in the right sector, we can significantly outperform the market. But we come out of this very difficult period of months, I think, well positioned to take advantage of what's coming next. This bull market since the beginning is up 201% over 105 months. The bull market of the 80s and 90s is up 1,300% over just longer than twice what we've seen since 2013. So again, we put one foot in front of the other. We take the data as it comes. We're prepared to make changes. If things get difficult, we will play defense. We were pleased that we played defense well over the course of last year. We played defense well through the course of the sell-off in the 2020 bear market. And we would be very willing to play defense again should things get worse. With that, Pamela, if there's any questions, I just want to highlight the fact we are continuing to post actively on Twitter on a daily basis. There's 3-4 insights, I think, that we put up daily. I think that seem to be going well. Our subscriber base is growing. Certainly, I encourage you to subscribe to our videos off the website. And if you're interested in following the more tactical stuff, we're trying to talk about interesting things on Twitter as well. Pamela,
Thanks.
what do you got?
Yeah, Dave, lots of questions from some of our usual suspects, Harry, Lawrence, and Robert. You know who I'm talking about. Robert wants to know, David, what are your thoughts on the Russell 2000, given that we should be entering a period of positive seasonality? Does the higher interest environment dull the shine on the small and mid caps?
Okay, well, that's a fair question. Let me see what I can put up in front of us. Okay, I'm going to share my screen here. Okay, so Russell 2000. Let's start here. So Russell 2000 has started relatively outperforming in April. And after a long period of underperformance, in fact, we looked at a longer period, you can see that relative performance for Russell 2000 was weak from March of 2021 through to June of 2022. So these are smaller and mid-cap stocks. You can see that we're now above the 8-day, the 21-day, the 50-day, and 200-day moving average. So we're trading above all the longer term measures of trend. And certainly we're seeing better behavior than we are in the S&P. You're right, seasonally, this is a good time of year. I highlighted this morning when we get markets backing up a little bit, and the markets were backing up a little bit this morning. One of the things I like to focus on is what is it that's continuing to make relative new highs versus the market. And the list was relatively shorter today, 24 ETFs out of 6,200. But there's some pretty consistent themes. I'm trying to put these up on Twitter pretty regularly. Dividend growth has really been leading over the last number of months, certainly a lot better than fixed income. Europe and EFI is here many, many times. That's new. We haven't been seeing that until about a month ago. We've put about a 6% weight in our macro portfolio in Europe. Part of that is currency, and part of it is the indices themselves. But like the UK market just making new highs. France market's acting particularly well. But what we can say is that mid cap and small cap stocks are really well represented in this relative strength new high list. Many times capped also with the value bent. But if we put mid cap and value together, they make up a lot of these ETFs that are making relative new highs. So I think they look very attractive, and we certainly are spending more time looking at mid cap stocks.
Thanks so much, Dave. The next question we have comes from Harry. He says, David, if the market keeps going up, employment stays at current levels, and inflation goes to around 4% year over year, how could the Fed not raise rates to 5.5% to 6%? This is not expected by the market? ?
Look, the market, as Diana said, the Fed doesn't want to kill employment. They want to kill inflation. And there are real scenarios where employment could stay firm, but big components of inflation can come out. So with rates going higher, certainly it has moved rents lower over the last 3 months. That's the biggest component of services inflation, and services has been very sticky. We've seen goods inflation come down. Certainly the goods components are much lower. We've seen transportation inflation come down. We've seen used car inflation come down. We made a case last week, and I'll see if I can just throw the chart up, where, let's see here. I can see if I can put it up. Zoom. Here we go, stop share and reshare. Let's look at this one here. Okay, share. So we put this up last week, and that is in the period of the 50s and 60s through the rate cycle, there weren't big accidents like there were in the period of disinflation where the Fed was raising rates against the grain. In fact, you had 2 years of inflation, 1950 and 51. Then inflation went back to low levels and employment grew. And the period of the 50s was a very prosperous period. And if you look at the stock market, it was a great period for stocks, even though rates were rising. So we have this view, because every time we had a rate increase cycle since 1980, you had some accident, that we have to have accidents. It may well be that in a reflating economy, we can handle rate increases. Now, if the big components of inflation are moderating, we're not trying to destroy employment. In fact, you'd love to maintain levels of employment as long as inflation is a reasonable level.
Thanks so much, David. The last question for this afternoon is about near-term equity market performance. David, a lot has been recently written that when the VIX falls below 20, which it is now, that has not bode well for near-term equity market performance. What are your thoughts?
Well, okay, people have been saying that because that's what's happened over the last year. So let's take a look. So this is near-term VIX since February of last year. And to that point, when you got down to these low levels around 20, you had a period where they started to climb. Let's look at it over 5 years. Okay, 5 years in VIX can come down. This is through 21. Let's go even further. Let's look at all of the years back to 1991. You can see that VIX has come down and stayed down for months and months at a time. Months and months at a time. In fact, the best performance for equities is when VIX has been 13, 14, 15. So because we've been elevated many times over the course of the year, and we have been in a very tricky market, people have had that view, but we've just broken recently below the last 3 lows. So it's not impossible that actually volatility is coming out for the right reason at the right time. So I am not so concerned about it. Now, if we were looking at this on a daily basis and looking at overbought and oversold, overbought when we get to the top end of this range here, overbought when we get to the top end of this range here, overbought when we get to the top end of this range here, fine. We are not oversold. We are not oversold. So VIX is not oversold like it was in November or it was in October at all. So I'm not so fussed about that. I think actually low volatility means maybe things are healing. When we had these other occurrences, we did not have them with this improvement in breadth that we're seeing in the market. So just because the market has rallied like it did in other cases into this kind of resistance, in these other cases, we were not seeing the kind of breadth improvement we're seeing right now. So what's happening right now is different than those other occurrences.
Thanks so much, Dave. We'll leave it at that, but if you don't mind, maybe giving 2 or 3 Canadian ETF recommendations that you hold in Global Macro for Lawrence, he'd be very appreciative.
Okay, well, it sounds like the fire alarm starting to go off here.
Oh boy.
XGD we own for the golds. I think it looks quite good. Here we go. You can see these, I take it. So this could certainly pull back a little and consolidate. If I could buy it around $18 for new additions, that would be really great. Certainly the XEG from a energy perspective, I think looks quite good. And they're having a fire alarm. And then the last one is XIU, and that's just the broad-based TSX 60 ETF. It's acting quite well. Again, these can all consolidate a little bit, but you saw that data like 60 days out in 100% of the occurrences, market was higher. So don't fiddle around too much. Know that if you buy here, you can pull back 4 or 5%. If you happen to get a 4 or 5% pullback, I would be buying with both hands, and we go from there.
Thanks so much, Dave. I'll leave you with the final word and get those in fast before you have to get out of the building.
Listen, the final word is I encourage you, if you're interested, if you like these webcasts, you like the content, consider subscribing to our Twitter account at Barometer CA. We put up a lot of content. Use our website. Don't hesitate to go there to look at other content. We're going to try and clip these webcasts into some smaller pieces for specific insights. And don't hesitate to reach out and tell us what we're not talking about. Ask us questions. If you want to talk to somebody at Barometer, we're here at the end of the phone, and we're always interested in meeting new people. So thanks so much for tuning in. We'll talk to you again next week.
Thanks, Dave. Thanks, Diana. Have a great evening, everyone.